I want to talk today about something that's quietly unfolding beneath the surface of the housing market, something that affects buyers, investors, and everyday Americans in very different ways. Over the last several years, institutional investors entered the residential housing market at an unprecedented scale. Hedge funds, private equity firms, REITs, and large asset managers bought single-family homes aggressively, often above market value, often waiving inspections, often outbidding owner-occupants. At the time, the strategy made sense on paper: cheap debt, rising rents, assumed perpetual appreciation. But markets don't move in straight lines. As prices correct, carrying costs rise, rent growth slows, and liquidity tightens, many institutional buyers are now facing something they did not model well enough: negative mark-to-market exposure. In plain terms, some of these portfolios are now worth less than what was paid for them. This creates a mixed blessing. For individual buyers and small investors, institutional pullback can restore something the market desperately needs: less artificial demand, more negotiating power, fewer, no inspection, all cash bids, better price discovery. If large players begin trimming portfolios or exiting certain markets to cut losses, inventory may increase, and prices may finally reflect fundamentals instead of capital excess. But here's the other side of the equation, the side we cannot ignore. Institutional housing exposure does not exist in isolation. These homes were financed, securitized, leveraged, and packaged into mortgage-backed securities, real estate funds, pension allocations, and retirement products. That means losses don't just stay on an investor's balance sheet, they ripple outward. Pension funds, 401ks, target date retirement funds, insurance reserves. When large pools of capital experience drawdowns, it can affect returns for workers who never bought a single rental property, but whose retirement savings are indirectly tied to those assets. That's the uncomfortable truth. What helps affordability can temporarily hurt portfolios built on perpetual growth assumptions. So, where does that leave us looking forward? Here's the key insight, and this is where experience matters. Corrections don't end markets, they reset them. If institutional investors decide that residential real estate no longer fits their risk profile at prior pricing, spring 2026 may represent a window of opportunity, particularly for well-prepared buyers and disciplined investors. Why? Because forced sellers don't wait for perfect timing. They rebalance, they reduce exposure, they cut losses. And when capital exits, pricing becomes rational again. That doesn't mean reckless buying. It means selective, well-underwritten acquisitions by people who plan to live in the home, hold long-term, or invest based on cash flow, not hype. History shows us this clearly. The best buying periods are rarely when optimism is loudest, but when large players are quietly stepping back. The takeaway is not fear. The takeaway is preparation. For buyers, this is a reminder to be patient, informed, and financially ready. For investors, it's a reminder to underwrite conservatively and avoid chasing yesterday's returns. And for policymakers and retirement planners, it's a reminder that housing is not just shelter, it's deeply embedded in our financial system. The next phase of this market will reward discipline, not speculation, and those who understand that distinction will be the ones positioned to benefit when the reset is complete.